Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Welcome, Professor. Today's October 28th, 2025. We're here with renowned econ professor Edwin T. Burton from the University of Virginia. Professor, the Federal Reserve meets today, tomorrow. Tomorrow they're going to set the federal funds target rate. What are they going to do?
I think they'll lower their target for federal funds from the current range. They do a range as opposed to a particular rate. They'll lower the range from 4 to 4 1/4 to 3 3/4 to 4. So it's the first time we've seen a 3 handle. The reason that's going to happen is the bills are now trading in the 380, 390 range. That'll force them down to 3 3/4, 4. Now, the interesting thing about the Fed announcement will be that Powell will be asked about the December meeting, whether or not they're going to do something in December. That's the next meeting. And he is going to be hard-pressed to be encouraging because the bills still have to fall another 25 basis points to permit him to even do that. So he'll be really evasive about what they're going to do in December. But he doesn't want to be too evasive because if he becomes too evasive, he's going to encourage the view that they won't do anything. The reality is the market sets those rates anyway. And so the question is, what do the bills do between now and then? If the bills come in 25 basis points, then they'll definitely make the move. If bills don't, they won't. But it's not in the interest. You can't imagine Chairman Powell saying, I want to announce to the world that we're powerless. We don't really set these rates. That day's not coming. He's going to be, oh, yes, we're going to do this or that or the other. But the truth is, watch the 2 and 3 month Treasury bill yields. Wherever they go, the Fed will follow.
If the Federal Reserve wanted tomorrow to lower the range 50 basis points, could they?
Yes. But what they don't know is how many Treasury bills they would have to buy to force that down there. They can't just do it because if you can borrow money, say, at 3 and invest it at 4 or close to 4, which is what would happen if you lowered to 3 tomorrow.
Do you mean invest in a Treasury? Where would you borrow it?
You just repo it out at 3, whatever Fed funds rate is.
For our listeners, can you explain what a repo is?
Well, repos are complicated, but they trade. They're a way of borrowing by providing Treasury collateral. And so if you can earn 4% and then finance it at 3, and there's no risk to you at all, which there wouldn't be, you would do an unlimited amount. You might do trillions of dollars of that if you can pull it off. They want to avoid that. They're aware of the arbitrage. They're never going to let the T-bills trade outside of their range. So if you look at the repo market and the bill market, they're pretty much right on top of one another.
Professor, almost every day, the S&P 500 is setting a record high. What in the world is going on with the economy? Amazon announced 25,000 job layoffs. UPS is announcing layoffs. How do we have record highs in the stock market?
That's an interesting situation. We've had a bifurcated economy for a while. That is, one group of Americans are doing great and another group of Americans are doing not so well. And it's what we call the real economy that's fairly weak. The real economy is growing pretty slowly. The price increases that you see every month, the price inflation continues to trickle along at about 3 to 3.5%. And so that is a slam at about 70% of the economy, 70% of consumers, because that group doesn't have large amounts of savings. They're pretty much hand-to-mouth or paycheck to paycheck, depending on what part of the income spectrum they're in. So that part's weakening, really. They're having trouble getting housing, having trouble paying rents, having trouble paying utility bills. And just recently, it came out that the Obamacare cost for health insurance for a family of 4, an average family of 4, has now reached $27,000 a year, $27,000 a year. It's unbelievable. Here in Virginia, the average family income is $80,000. Look at that and compare it to the $27,000 for health insurance. It's a staggering situation. But on the other hand, every week goes by, we met a new group of AI billionaires, folks who think spending 50 to 100 million to buy a beachfront home somewhere is nothing, not even an expenditure. And you see them regularly. There's a lot of activity in the AI market, a lot of new companies. You have Sam Altman constructing billion-dollar deals for OpenAI every day. And Sam's only doing it for the good of humanity, he tells us, as he goes back to his $50 million home and relaxes to meet more folks in pretty much his situation. So it's a strange economy. And what's powering the market is 7 stocks make up about 35% of market valuation. And those stocks are booming. And you know who they are. They're Meta and Google and Netflix and NVIDIA and Tesla. And that group are doing very well. The average stock's not doing as well. For example, in the real estate market, you're a real estate investor yourself. In the real estate market, the public REITs, they're down anywhere from 8% to 20%, depending on which stock you're looking at, on the year. Yet it's a very strong market overall, but it's the tech sector that's booming. And if you're not closely related to that sector, you're likely to not be doing as well. So the stock market is bifurcated as well as the real economy. This is not typical. Normally the economy sort of moves up and down in unison, but that's not what's going on right now.
Last week, Andrew Ross Sorkin came out with his new book, 1929. When was the low point in the crash of 1929, and how long did it take for those stocks to recover back to the January 1929 level?
29 was a heck of a good year, actually, until you get to about March or April. 29, the market hit an all-time high in February. And so it looked like a great year. Herbert Hoover was sworn in for his presidency in March of 29. In those days, we swore the presidents in March, not January like we do these days. And Hoover was pretty excited. He was the man that ran on chicken in every pot and looked like there was going to be a chicken in every pot. But then you began to have hiccups all during the summer. The market weakened. The Dow had reached a peak of around 420 earlier in the year. And then in October, you had 2 days that amounted to a 22.5% drop in the stock market. And that doesn't sound like as much as it really is. If you think of how much margin there was at that time in the stock market, you didn't have an SEC and a Federal Reserve controlling the margin lending rates and all that. It was just the Wild West in the stock market. And so a lot of folks were just cashed out, went bankrupt. And some of them didn't even know it. If you lived in the Midwest, you couldn't even get information about what the stock market was doing, but you might own a stock at 60, find it close at 70, but you got cashed at 15 earlier in the day when it traded at that level because you weren't able to follow it minute to minute, and there were all kinds of scams and bad things happening. But the economy was also weakening, and you were beginning to have the first round of bank failures. Over the next 4 years, 1/3 of all American banks would fail from 1929 to 1932. And by the time Herbert Hoover is sitting at a Republican National Convention in the summer of 32, the stock market was 40. It had lost 90% of its value in 4 years. And the unemployment rate had gone from 3.5% to 25%, 1 of every 4. We've never seen numbers like that, really. And briefly got back to 20. There was a rally in the early 30s, but then after that, the economy fell down again and reached 20% in the mid-30s. The 30s were a barren decade. The economy was weak for a decade after the market crashed, and it wasn't just 29. Ross Sorkin has come out with a book entitled 1929. It's interesting, but there are a couple of things then you got to wonder about. For example, Sorkin seems to think the Federal Reserve was created to control interest rates. That may have been what Ross Sorkin thinks, but that's not what the Congress thought when they passed the Federal Reserve Act in 1913. They thought they were creating a bank to be a lender of last resort to replace J.P. Morgan and all the annex that he went through in the panic of 1907. So Sorkin might need an extra research guy or two, or maybe it was some artificial intelligence thing that went awry. They do, you know. But 29, the story there was that the market collapsed over a 4-year period, and it was consistent. Every day you came in and the stock market lost more value, and from top to bottom, it lost 90% of its value. You can't imagine what would happen if that were to happen today. That would be amazing. It would wipe out an enormous amount of worth. And what happened, interestingly enough, when all the banks failed, there was a third of the banks failed, what did the Federal Reserve do? It did absolutely nothing. And lowering rates wasn't one of the ideas because rates were zero. Rates were pretty much zero all during the 30s. T-bills went at 0.25%. We didn't have long bonds in those days, but we did have Treasury bills.
Did they print money? Did the Federal Reserve
no, they didn't do anything. The Federal Reserve just sat on their heels. Friedman wrote a book criticizing the Federal Reserve for its actions there. He argued that the Federal Reserve should have increased the money supply and offset that decline of 25% in the money supply. Actually, it was closer to a third of a drop in the money supply. Historic. We'd never seen anything like it. We saw a little bit the opposite of that in the 70s and then again recently in the 2020 to 22. For fun, if you are a user of AI, go on AI, ChatGPT, or any of them, and ask them, how much did the M2 money supply grow from January of 2020 to March of 2022? What do you think it would be, Hunter, if you ask that question? The answer, depending on which AI you use, is 40 to 45% in a year and a half. That's how much the money supply grew in that period. But it dropped by almost that amount in the early years of the Great Depression. So money does matter. It's not irrelevant. Interesting enough, most academics think money does not matter at all. So when that 40% increase in the money supply, 45% increase in the money supply happened, when the economy was shut down, they assumed it would have no effect on the value of money.
Well, if it has no effect, why not just print money every day, all day long?
That's the question I've been asking at academic conferences. This works so smoothly, why do we tax people? After all, we increased the money supply by $7 trillion, and the annual take from taxes are $5 trillion a year, corporate and federal income tax. So if they believe that had no impact, then it wouldn't have any impact now. Let's just get rid of taxation. And of course, that's absurd. Anybody knows that would be very inflationary. But they didn't think so at the time in 2020 and 21 and 22. You wonder why. Even Janet Yellen, who was the principal advisor to the Biden administration, kept saying, we can go big. Rates are low. They didn't stay there. So that's where we are.
Professor, can you speak to tariffs? Our president, in a fluid fashion, raises and lowers tariffs. He's in Japan recently. What's the net effect of tariffs on the U.S. economy?
Well, I have to say, Hunter, I think my views on this subject are probably unique to me. I don't really see the point of tariffs on China. I really don't. I don't think America can manufacture everything it needs. I think it needs to trade with China. It needs a peaceful China. Doesn't need to antagonize China. And the Chinese aren't the perfect democracy. It never has been. But the Chinese government is much better than it was, say, 4 decades ago. And the Chinese people have made greater strides than any people on the face of this earth. There's no other country that's done more for its population than the Chinese government. You look at these cities like Shenzhen, where the iPhone is made. There are 7 million people in Shenzhen. There were maybe 20,000 living in that province just 4 decades ago. And they have prosperity. The per capita income in China, if you go back 4 decades, was $200 per year per person. It's about 40,000 per year in Shenzhen today, and about 30,000 for the entire East Coast. If we could do that for imagine raising the standard of living in this country by that kind of multiple. And I think that has to be praised. I'm not a fan of totalitarian governments. I don't like them at all. But China has always had totalitarian governments. That hasn't changed. Mao certainly wasn't an improvement over the current leadership. The current leadership is an improvement over Mao. I think few people would doubt that. The Cultural Revolution was an effort to punish the Chinese people. But what's happened in the last 30 years has improved the plight of the Chinese people, and we've benefited. Everybody that walks into Walmart or buys a television or an iPhone or whatever you buy has benefited from our relationship with the Chinese, and I think the Trump administration is dead wrong trying to blow it up. Now, having said that, I realize that all of my friends on the Democratic side and all of my friends on the Republican side disagree with that. They somehow want to think of China as some evil thing. I think what's happening here, China's competing with us for the economic leadership of the world. That's what's going on. And I think Americans don't want to lose that leadership. But if you don't want to lose that leadership, tariffs are not the answer. The answer is, in fact, no tariffs. Make U.S. companies stronger. That Ronald Reagan quote that Canada ran was right. Ronald Reagan said, if you don't have tariffs, your companies have to be stronger. They have to if you want your companies to be weak, if you want the American automobile company not to be able to compete, put big high tariffs. Keep all the foreigners out, and what will happen? The U.S. automobile company will learn how to produce the worst cars in the world. They figured that one out when Japan started producing cars and other countries. The U.S. auto industry lost its huge market-dominant position. We protected it. Jason Riley wrote a book called Please Stop Helping Me. And he's arguing that all the things that people do to help poor people often make problems worse. And a lot of our policies internationally do the same thing. We need to think harder about the policies we do and the impacts they have. We're not improving our economic situation by viewing China antagonistically, I think. And politics aside, you don't have to be a fan of the Chinese government to acknowledge that this government has done a lot for the average Chinese, especially that's 350 million people brought into the middle class. I think that deserves a round of applause. And I think the last thing we need is to get out the sabers. And just to move to a political note, that's not my specialty, so I'm in dangerous ground here. But I think China, long run, will have hegemony in Asia. That is going to be hard to avoid. Yes, we have close friends in Japan and Singapore and Australia, but their trade is with China. These countries are trading with China, large amounts, even Japan. You'd be amazed at the Japanese-Chinese trade. And eventually Australia will go into that orbit. And if you trade a lot with people, you're going to become their friend. There's no way out of that. Even Taiwan has massive amount of trade and movement back and forth to the mainland. It's not like Taiwan is some armed camp and there's no going back and forth. Taiwanese have relatives on the mainland. And in many ways, Taiwan, Singapore, Hong Kong, Philippines, those families are Chinese, many of them with relatives on the mainland, and they financed a lot of the Chinese economic growth. Now, I realize this is all pretty controversial, being pro-Chinese, and no one Chinese government is paying me to say this. Just speaking as an economist, trade is a good thing. Trade is always a good thing. When people voluntarily, this is a voluntary thing. People don't have to buy iPhones. They don't have to buy. I recently, Hunter, I got tired of losing $300 sunglasses. I lose them now and then. And I don't buy them, by the way. My children buy them for me, and they give them to me for my birthday, and within a week they're gone. And so I'm trying to figure out, what do I tell them?
You lose them.
So I found out a way to avoid losing $300 sunglasses. I noticed on Temu, a Chinese version of Amazon, that I could buy 14 sunglasses for $42 total, $3 a sunglass. So now I wear those, and they are absolutely great. Someone stopped me the other day and said, "Where'd you get those beautiful sunglasses?" And you know what I told them, Hunter? You think I told them I bought them for $3 at Temu? No, that's not what I told them. I said, I paid $500 for these, but if you'd like a pair, I can get you a pair for $200. That's what I told them.
How many pairs have you lost?
So far, I've lost none. Once they come in at $3, you somehow don't lose them anymore, which makes me wonder how I was losing them in the past. Can you imagine how wonderful it is to buy 14 wonderful sunglasses for $42? I think that's great. And somebody in China benefited from that trade because they're a much poorer country. And they can actually make money selling me a $3 pair of sunglasses. It works for both of us, for me and for the person selling it to me. So I don't want to overpraise China. They certainly have done some bad things, but every country has done bad things. But they've been more help to us than harm. And I think if you want to compete with China economically, you need to start thinking about the education in this country and promoting free markets and letting people develop things and come up with different ideas and markets. Like, take AI, for example. Every time you tune a congressman in on AI, what's he saying? How can we regulate AI? Maybe we should encourage people to be using AI. And anybody that's used it very much knows that it's very good for some things and terrible for others. And we should take advantage of that. If there's something that will help us in our daily lives, let's use it. So I think we need a better attitude of kind of looking forward and into the future as a country. I think China's doing that better than we are. I see I've had a lot of Chinese students over the last, say, 20 years, hundreds of them, and they're very forward-looking. They go back to Beijing and they start businesses. They're in Singapore starting businesses. They're not the kind of image of the communist Chinese you might think of. These guys are more entrepreneurial than some of the people I see right here at home. And I think that's where the battleground should be. The battleground should be in the economics, but you're not going to get there by putting up tariff walls. If you put up tariff walls, do you think there's not somebody else that can't make that NVIDIA chip somewhere in India or Vietnam or somewhere? There is nothing you can put up a tariff wall and protect. Long run, other countries will start building that. And China sees that, and they're now making all kinds of arrangements with other countries all around the world. And even with the Eurozone, China's been making, look at BYD cars. BYD cars are sold there. We won't even let them sell any here. They can make a car that we could produce for $50,000. They can make it for $10,000, same car. But we prohibit letting our citizens buy it. Is that good for America? Is that good for Americans? That we can't buy something worth $50,000 by paying $10,000? I don't see it.
Probably good for the car manufacturers, but not for the consumers. Would you agree with that?
It'd be great for the consumers if they could buy it at $10,000, yes.
Right.
And these cars, if you look at it, they're certainly good enough for a lot of European countries. And it's causing political problems in Europe because obviously the car manufacturers in Germany, for example, are not dying to see these BYDs. But if China can produce something that we all need globally and produce it at a fraction of what it would cost us to produce it, why not let them? Why don't we do that and work on other arrangements to build a better relationship and encourage them to move toward some of the political goals that we like, to move toward more freedom and democracy and free expression. But I think putting up tariff walls takes us in the opposite direction. I think the Trump administration has made a big mistake here.
The pushback is if China starts manufacturing 100% of our goods, then what do we do?
How do they do 100% of our goods? That's a little hard to do. If that made sense, why doesn't Texas just produce everything it needs? Why do they buy anything from Louisiana? Does that hurt Louisiana or Texas? Why doesn't this work with the states? Why doesn't Indiana produce everything that Indianans need? Why don't they produce their own auto industry or something like that? Why don't they just do that in Europe? Why doesn't Germany produce every kind of thing that they need and France everything they need? Trade is good. If a citizen of France has a red marble and he knows someone in Germany who has a blue marble and they want to trade them, why don't we let them? That's in essence what's going on between the U.S. and China. Americans would like cheap TVs. They'd like cheap cell phones that work, that are really good. They'd like cheap cars that really work. And they'd like to trade something for them. That's a good thing, not a bad thing, and it shouldn't be impeded.
Professor, if we were to grade your past predictions on the Federal Reserve, Fed funds target range, you'd have a 100% A+. Tomorrow, the Federal Reserve sets the range. You've predicted 25 basis points reduction in that range. My guess is you'll get a 100% on your exam tomorrow. Tomorrow we'll find out. Thank you, Professor.
Thank you. I should tell you that while I am good at predicting Fed rate cuts, let me tell you my stock market records. If you had invested carefully with everything I think the stock market's going to do, you would no longer have any money. My stock market record it almost defies reality how bad I am at guessing the stock market. But it turns out I'm really just kind of a random guesser. My views on the stock market are worth absolutely nothing.
Will you tell a story, please, about the gentleman who called in and asked your prediction of the stock market, and he was doing the exact opposite?
My good friend Brewster Ellis. He did exactly the opposite, and after he did exactly the opposite, he said, "Eddie, I always make money talking to you."
Professor, thank you. You're the best of the best. Thank you.
Thank you.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.